Alright, hi everyone, this is Manas, and in this lecture we'll be covering the second module under alternative investments for CFA Level 1 curriculum. This module covers performance calculation and appraisal of alternative investments. This lecture will be in Hindi and English mix, so I hope you enjoy it and do leave your comments. So to begin with, we understand that performance appraisals or performance calculation is not only a quantitative exercise but also a very qualitative exercise, especially in case of alternative investments. Why is that? Because besides just the numbers and risks, we need to also understand that there are a lot of issues associated with alternative investments which are not present in case of the traditional ones. For example, limited transparency. So in the previous video, we also discussed that a lot of the data for, let's say, hedge funds or real estate investments or private equity investments, they are not available publicly. So it is difficult to understand how the fund is operating, what are the strategies they are applying in detail because of this transparency issue. There is relatively low portfolio liquidity. Unlike stocks and bonds which are traded on the exchanges every day, a lot of the assets that are owned by alternative investments, they are not traded publicly, and if someone wants to get out of the position, it is relatively more difficult. Then a lot of the hedge funds or private equity funds, they deploy a lot of high leverage and they also use derivatives. So because of that, the returns are asymmetric, which is also a risk associated with these products. Then, as discussed, they make their products in-house, which is why the complexity is higher compared to what we have in case of traditional assets. Then mark-to-market issues, especially for specialized products. So a lot of these assets that a lot of the hedge funds own, they are not traded publicly, so the valuation is difficult for these products. So they use internal models to understand, okay, this is the value of this particular asset. It may not be necessarily the case, but that's what the market is saying. So they are marking, it's difficult to mark to market for such assets. Then there is limited availability of redemptions. Once you invest in a fund, it is difficult to take your money out. Then there is always an issue with manager selection and diversification. And besides all that, there are also high fees associated with investing in alternative investments, which might have a meaningful impact on performance. We'll be looking at this with an example later on in this video. So what are the common methods that are used to calculate the performance of different alternative investments? So the first one is Sharpe ratio, relatively straightforward. You have the return of the portfolio, you have the risk-free rate, you divided by the standard deviation of the portfolio, are you able to calculate the Sharpe ratio. The higher the Sharpe ratio, the better the risk reward return. The pros of this method, simple to calculate, no issues here. बट बिकॉज यहाँ पर हम पूरे पोर्टफोलियो की स्टैंडर्ड डिवीजन ले रहे हैं, यहाँ पर अपसाइड एंड डाउनसाइड वॉलेटिलिटी बोथ को पेनलाइज किया जा रहा है. एंड अनदर इशू इज इट अज्यूम्स अ नॉर्मल डिस्ट्रीब्यूशन. In case of alternative investments, normal distributions might not necessarily be the case. There might be asymmetric distributions. Then an advanced version of Sharpe ratio is Sortino ratio. It's very similar to Sharpe ratio, but डिनोमिनेटर में यहाँ पर डाउनसाइड रिस्क जो है पोर्टफोलियो के हम उस पर फोकस करते हैं. बट बिकॉज ऑफ दैट, लाइक वी आर एबल टू कैप्चर द डाउनसाइड रिस्क रिटर्न रिवॉर्ड रेशियो, बट इट्स रिलेटिवली मोर डिफिकल्ट टू कैलकुलेट. We'll be looking at these with an example later on. And as I mentioned, we are able to capture downside risk, so we are able to capture the correct ratio for a high volatile portfolio. Then we have MAR and CalMAR. So what they do is it's basically a ratio of the compounded annual rate of return of the portfolio, like since inception in case of MAR. For CalMAR, it is over a certain period, and we divide it by the maximum drawdown. So better the ratio, better the performance risk reward of that particular asset. So यहाँ पर जो इसका प्रो है कि भाई ये पूरी हिस्ट्री को एनालाइज करता है. वही कौन हो जाता है कि भाई हो सकता है इनिशियली इट मे नॉट बी दैट रेलिवेंट, recent performance is relevant. CalMAR is because focused on, let's say, recent performance, so यहाँ पर पूरी हिस्ट्री नहीं कैच कर रहा है. So based on where it is more relevant, we use CalMAR or MAR. Both are used for hedge funds and commodity trading advisors. So as I mentioned, for Sharpe ratio, the underlying assumption is that distribution of returns is normal. But in reality, that is not the case. There is leverage there is illiquidity, there is less transparency. Because of that, the returns can be skewed. So it can be a positive skew or a negative skew. And unlike a normal distribution with normal tails, there can be fat tails as well as thin tails, which might be impacting how the returns are of that portfolio. Let's look at some of the calculations in an Excel example. Look at an example for portfolio return calculations. We'll be looking at Sharpe ratio, Sortino ratio, and Kalmar ratio. We'll be covering these in details when I record the quantitative methods, but a short example should be helpful to understand how these calculation methodologies differ. So let's say we have a data set of 10 values of 10 monthly returns of a portfolio, and the risk-free rate is 0.5%. So we know the average portfolio return, simple to calculate the average. And for Sharpe ratio, we calculate the excess return every month, simply the return of that month minus the risk-free rate. So we get all the values, we square them up, and the average of that is the variance. You can also calculate the variance using var.p formula. You'll get the same value. Similarly, the standard deviation is the square root of the variance. You can also use the standard deviation.p formula. So p is used because p is the population here. If you have a sample size, then we'll go with s. So we have the standard deviation. Now the Sharpe ratio is the return of the portfolio minus the risk-free rate divided by the standard deviation. Great. So we calculate the Sharpe ratio. In case of Sortino ratio, what we do, we calculate the excess returns, but we'll only take into account when the excess returns are negative, because we are trying to capture the downside volatility. So we'll calculate all the excess returns, and if it is more than 0, then we'll make it 0, otherwise all will remain negative. Then we square them up, take the average, that's the variance, the standard deviation, and the Sortino ratio will basically be the average of the excess returns, which is this, divided by the standard deviation. So you'll notice there's a difference, and it will help investors understand how the portfolio is performing in case of just taking into account the downside volatility. For Kalmar ratio, so let's say a fund starts with $10,000 and it goes up to $11,500 at the end of year 1. So we make a gain of 15%. But during this entire year, the fund went down to a lowest value of $8,000. So the max drawdown here is 8,000 by this, minus 1. So 20% drawdown. So the Kalmar ratio is basically the annualized return divided by the maximum drawdown. So from this we can understand for every 1 unit of risk, the fund returned 0.75 units. So Kalmar ratio in general, if it is more than 1, then it is a favorable risk adjusted return. If it is less than 1, then it is less favorable. How can we say that? So because we made a gain of 15%, but the drawdown was 20%, right? So the risk was higher. So let's say the drawdown was only 10%, then the Kalmar ratio would be 1.5. So the unit of risk was 1, but the return was 1.5. So that is why the portfolio was more favorable on a risk adjusted return basis. Now there is another issue with private equity and real estate performance evaluation. So a lot of these private equity funds and real estate funds, they require a large amount of capital in the initial years, and later on they start generating money. So a simple way to look at it would be, let's say you go out, you purchase an office building जहाँ पर एक tenant रह रहा है and there are a lot of vacancies. So what you will do, you will put in more money into the building, renovate it, and once the building is ready to go, you will try to lease it out to more tenants, and you will generate more and more income going forward. So that each time you request for capital to provide for those improvements or investments, that's termed as a capital call, and the return structure that is generated in these funds is a J curve. Another thing that is important to note, what a lot of people do, so they use IRRs to calculate, okay, how the investment is performing. And a lot of people also use a term called multiple of invested capital to understand, okay, this is the amount of times our money will be once the project has been completed. Let's look at J curve and MOIC with an Excel example. Okay, so we'll look at an example of J curve using real estate cash flows. So let's say go ahead, invest in a fund which purchases a property for $500,000, and there might be some tenant in, so you will be generating some revenue. In the initial years, we'll put in money to renovate the building, add more features to the building to attract more tenants. So you'll see that there will be capital expenditure happening in the initial years, which will go down with time because the building would be fully renovated and we'll be covering some basic costs. But as we attract more tenants, the revenue will go up. So this is what J curve would look like in terms of a real estate investment, or it may be the case for a private equity investment as well. So what investors do in this case is try to understand the returns from an IRR point of view. So IRR is relatively easy to calculate, where we get the net cash flow of each year and we take the IRR of that. Another function that is used is the equity multiple, or multiple of equity or investment capital. So this is basically a ratio of how much cash we are able to generate, which is cash out divided by how much money we put in. So we get an equity multiple of 2.09. So it gives us an understanding of, okay, we get basically twice the money back, but this multiple does not allow us to understand, okay, how long did it take, right? Had we gotten it in just, let's say, 4 years, this equity multiple would have been the same, but the IRR would have been higher. So people take into account both while trying to understand, okay, whether the investment is worth it or not. Now we'll go to hedge funds. So in the previous reading we discussed, the various strategies a lot of hedge funds use, like long short, short biased, market neutral, opportunistic, event driven. So all of these strategies, they use a lot of leverage. Because of that, the gains भी amplify होते हैं and losses भी amplify होते हैं. So what hedge funds do is they use derivatives. It can be options, it can be futures, it can be over the counter options, or they simply borrow from prime brokers. So for that, they need to establish margin accounts. They need to be aware of what the interest rates are, by fees क्या लग रही है, because these all impact the net returns a hedge fund will be able to generate. Then illiquidity and redemption pressures are another issue which hedge funds deal with. Illiquidity is basically difficulty of getting out of a position. It can be because of various reasons. भाई stock की अगर volume ही low है, and if you own a lot of the stock, so if you go out on the market and sell your entire portfolio in one go because the volume is low, आपकी price down हो जाएगी because इतने buyers ही नहीं है. Sometimes some of these bonds which these hedge funds own, ये trade ही नहीं होते हैं. So it's very difficult to figure out what is the right price because there are no buyers or sellers. And in some cases there are highly liquid over the counter contracts. So these are custom contracts that are made for particular hedge funds. So because these are very specific, it's very difficult to sell it to somebody else unless उसकी वो requirement नहीं है. Then with real estate, same thing. If you purchase an asset today, if you want to get out of the position, let's say a month later, it's not very easy to sell that real estate property that easily. Alright, so a lot of the assets that are owned by hedge funds or private equity funds, they can be categorized on 3 levels based on availability of pricing. So level 1 assets are those which are exchange traded, so इनकी prices publicly available हैं, so they are relatively easy to value. Then level 2 assets are those जो exchange traded नहीं है, but if you reach out to prime brokers, so prime brokers are institutions which cater to large institutions or hedge funds. For example, in case of let's say interest rate swaps, so उनके quotes आपको broker से मिल जाएंगे. And then level 3 assets are those which are the most difficult to value reliably because they are only computed based on internal models. So ना broker quotes available है ना वो publicly trade हो रही है. So how do hedge funds, deal with the redemption pressures? So the first thing is redemption fee. So to discourage redemptions when hedge funds are not performing well, hedge funds they charge a redemption fee. Why is that? Because if a lot of redemptions happen at the same time, तो मैनेजर्स के लिए डिफ़िकल्ट हो जाएगा कि वो अपनी पोजीशंस को लिक्विडेट करें और सेल करें. So because of that, they charge a fee so that the pricing of that asset does not deteriorate even further. Then they also have a notice period. So if I want to get my money out, I have to inform the fund 3 or 6 months in advance. In that case, the hedge fund will have time to, liquidate the position or arrange new capital to take over that position. Then there is also a lockup period, like a minimum investment period जब आप पैसा withdraw नहीं कर सकते हैं. Let's say in case of real estate, the fund manager says कि भाई हमने प्रॉपर्टी परचेज करी है, 2 साल तक वी वोंट बी सेलिंग इट, विल बी सेलिंग इट आफ्टर दैट. एंड अ गेट इज द प्रोविजन. सो जब रिडेम्पशंस हो रहे हैं तो एक रिस्ट्रिक्ट कर दिया है कि एक सर्टन अमाउंट में एक्स अमाउंट ऑफ मनी ही आप विड्रॉ कर सकते हैं. यू कांट विड्रॉ इंटायरली. सो देयर आर लिमिट्स टू हाउ मच यू कैन रिडीम. So it is important that investors understand the liquidity positions of the funds they are investing in. So we'll go over a calculation structure of fees with an Excel example. Okay, so to understand calculation of fees and returns for investors and the GP or the manager, we'll look at an example from the curriculum. So let's say in year 1 we make an initial investment of $100 million, and by the end of the year we are able to make $130 million. So on an investment level we made a gain of 30%. Great. But अब भाई पहले management fee pay करी जाएगी. So the management fee let's say is 2%. So 2% of the final assets under management. So that would be 2% of this. So we'll get 2.6 million. And now because the GP worked hard to make us money, he'll be charging a performance fee. Let's say the performance fee is 20%. So 20% on the gain. So that would be 6 million. So the total fee to the GP went is 8.6 million. So the net to investor was 121 million. So the net return to investor is 21.4%. Let's look at another example where the performance fee is calculated net of the management fee. So the management fee remains the same, but to calculate the performance fee, we take the 20% of what the profit was and we subtract the management fee. So that gets us to 5.48 million. So the fee to the investor to the GP went down. Investor returns went up slightly. That's why we have 21.92 million. Let's say we have a hurdle of 5%. In that case, the management fee remains the same, but the performance fee will be calculated after the hurdle has been achieved. So we'll also subtract the 5% hurdle on the initial investment. So the performance fee in this case comes out to be 4.48 million. Net return to investor goes up to 22.92%. Then let's say in year 2, what happens is we start with $130 million. That's where we ended in year 1, but we had a loss of say 15%, but we still have to pay the management fee to the GP. So that's 2% of the final assets, that's 2.2 million. So the net return to investor went down even further. And let's say the fund makes a comeback in year 3 where they end up making 12%. Now we have to pay the GP 2% of the final assets, and then we have to pay the fee we have to pay the performance fee net of management fee. So total fee to GP is this. Net return to investor is 7.67%. So in all the examples you will notice that even though we were making let's say 30% here, the net return to investor was much lower. So in this case it was a delta of 8.6%, 8.1% here. Because of the hurdle it went down to 7.1, and over here you'll notice it is 4.2. So the returns that are made on an investment level are much different from what the actual investor receives. So investors need to be careful in terms of they need to understand the details of the agreement between the GP and the LP so that they will also know what would be the net impact of fees on the return to these investors. Alright, so the last topic is basically understanding the alignment of interest and survivorship bias. So survivorship bias happens because a lot of the hedge funds which are part of the indices, so these indices they are updated on a regular basis. So what happens is जो hedge funds fail हो जाते हैं, and according to a study 1/4 of all hedge funds fail within 3 years, so they are removed from the index, right? So आपकी index overstate करेगी returns because they will be only stating the returns of the hedge funds which are surviving. The ones that are not non-operational, it may be due to multiple reasons. It can be due to performance issues, investor defection, in the sense that investors wanted all their money out. It was difficult for them to operate, and sometimes they are not able to cover the fund's operating costs. Then another bias is backfill bias. So hedge funds, because they are not required to report the data, so it may be that some hedge funds they only report data when they are performing well. If they want to attract more capital, so if they're performing well, they'll report data. It means ये कि आपका जो data है वो overstate करेगा, because the ones that are not performing well or they were performing let's say mediocre, वो report ही नहीं कर रहे हैं. So जो hedge fund में जो index में जो data आ रहा है वो सिर्फ top hedge funds का ही आ रहा है. So because of these two bias, as I said, the returns of these indices they are overstated. Right, as failed hedge funds are not included, and only well-performing hedge funds are included in these indices. All right, thank you.